Welcome to our 2022 webinar series, Risk Management with Insurance in a Post-Pandemic World. The COVID-19 pandemic taught us to adapt and accelerate trends socially, technically, and environmentally. As we inch into a post-pandemic world, risk management continues to be top of mind for most of us. Each month, you'll learn about insurance solutions you and your clients can consider, plus the significant impact to insurers and their post-pandemic strategies. Each webinar will last about 50 minutes, and you must be logged on for a full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. We'll answer all questions at the end of the presentation. Today's webinar is being recorded and will be posted on our website in case you missed it. Today's presenter joined LLIS in 2005 and has paved her way to covering various types of disability and critical illness insurance. She brings you and your clients the most up-to-date solutions in disability insurance. Here to present on alternative disability insurance solutions is Kathy Bilodeau.
Thanks, Claudia, and thank all of you for coming and tuning in. We're going to be exploring various disability options this afternoon other than just our usual individual disability. Options such as employer-sponsored group coverage or perhaps a combination of group and individual disability. We're also going to be reviewing some specialty cases that traditional disability is just not a good fit for, such as professional athletes or individuals who make an inordinate amount of money and traditional disability is just not going to cover all that income. But they're perfect for Lloyd's of London. And then lastly, we're going to touch on some critical illness, which is another option for certain situations where perhaps individual disability is not sufficient. So what we're going to be covering today, bear with me if we're going to be covering specialty coverage, some programs for business owners, and by specialty I mean things such as what you might have learned in the past with either our academy or past webinars is our new professionals program, our student loan programs, retirement protection programs, and also business owner programs. Our group coverage, we're going to be touching on that, such as individual life, short-term disability, long-term disability, vision, dental. We can assist with all those. And then also we can assist in the area of individual short-term disability if necessary. And then lastly, we're going to be covering critical illness. And again, critical illness is a nice solution when disability is not available or we need some additional coverage. So the first program that we're going to talk about is New Professionals Program. What is it? How does it work? Well, the New Professionals Program was designed by insurance companies, almost all of them have them, because they recognize that this particular segment of the population is going to be launching in an upward trajectory and are going to be earning a lot more money in the future. So what they want to do is they kind of want to get their foot in the door while they're still in training mode. So they might be students, they might be residents, they might be fellows, or they might be in their first year of practice. And what this does, it allows them to give them a dedicated benefit. So with the New Professionals Program, they don't care how much they earn. What they're going to do is they're going to give them a dedicated benefit amount depending upon where they are in their education and or what their occupation is. So, you know, whether they're a veterinarian or whether they're an engineer, it might differ in how much they're eligible for. Some good features about the New Professionals Program is they don't care whether the person has group insurance or not. So if it's a resident working at a hospital and the hospital is giving them 60% to $10,000, that's disregarded. So we're able to get them coverage regardless of whether they have group or not. In addition to that, again, they don't care what the income is. Obviously, if you're a student, you may not be making anything if you're not working. Another great feature is we could do something called a graded premium option. So instead of paying a more expensive level premium when someone only may be making $40,000, $50,000, $60,000 if they're earning something as a resident, this allows them to afford the disability program. And then in the future, we can do what we call here at LLIS a circle back. And we would reach out to them in the future, and once they have launched into their career and they're making a lot more money, we would remind them to convert that graded policy into a level premium. That way the premium doesn't continue to escalate in the future. Okay? So this is an example of what I was talking about, the dedicated benefit amount based upon what the occupation is. So here you have an OBGYN, they would be able to get anywhere from $65 to $7,500 during their first 2 years in practice. If they were a pathology resident, they'd be eligible for $5,000 to $6,500. If they were an engineer, $1,500 to $4,000. So a pharmacist would get $2,000 to $4,000. So you can see what I mean. Depending upon what their occupation is, would determine how much benefit they would be eligible for. So there are some riders that we particularly here at LLAS agree need to be on a disability policy, and particularly when we have the new professionals program. And that's because we want to make sure that certain features are on that policy in the event they become disabled. The first one is own occupation. The own occupation definition simply means that if your client cannot do the substantial and duties of their occupation, and they choose to, they don't have to, but if they choose to work in another occupation, they can collect 100% of the income from their new occupation plus 100% of their disability benefit. So they're literally getting the best of both worlds. So we feel that's a very important rider to have on the plan. Another one is residual, COLA, catastrophic, FIO up to 12,000, and not allowing an increase within the first. Now they are allowing an increase. They didn't used to do this. You used to have your policy enforced at least 1 year before they would allow you to increase your monthly benefit. And I'm going to go into greater detail on what these riders mean on my next slide. But the future increase option rider allows them to increase the monthly benefit as their income goes up. And what this is saying is if they launched, like a lot of medical doctors launch in July, and let's say they took out a policy in April, we could, in theory, go ahead and increase the monthly benefit to incorporate in the fact that they're now making $300,000 or $400,000, as opposed to having to wait a year for the policy being enforced to the following April, and then being slightly underinsured, for those 7, 8, 9 months. Okay. So some of the riders that we talked about, is the future increase option rider. And what this one does is it allows the client to increase their monthly benefit as their income goes up with no medical underwriting. It's simply financial. So if they can prove that their income has gone up, they would be eligible for an increase. The next one is what we call residual or partial. And this just simply says that there has to be a mechanism whereby if the doctor doesn't deem the client totally disabled and they're not eligible to collect a disability benefit, what's the safety net? This is the safety net. This would allow them to collect on the disability benefit if they're having a loss of income between 15 to 20%. And what they do is they look at the prior year's earnings and they compare that to them working now and see what the difference is. And this will allow them to dip into the disability policy while they're working part-time. The next one is the COLA rider, or what we call the cost of living adjustment rider. And this one is a mechanism whereby only when the person is on claim do we have a way to increase the monthly benefit. Now, if they're only on claim for a year or two, really not a big deal other than a year like this where inflation is sky high. But what this does is it keeps the monthly benefit. So if someone has a $5,000 monthly benefit and they're going to be on claim for 6, 7, 8 years, you don't want that $5,000 to remain stagnant. There has to be a trigger for this to increase. And what this does is every year when the person is on claim, it will increase the monthly benefit by the CPI. Okay. And oh, by the way, you don't pay premium when you're on claim. So all this is going on and they're not having to pay premium while they're collecting their disability benefits. This last one is my CAT rider. Meow. This is short for catastrophic. And what this rider does is it takes into consideration that if someone is catastrophically disabled, they're probably not going to be able to obviously work, and they're probably going to have additional benefits. So, additional need for benefits, because to be catastrophically disabled means 3 things. These are 3 categories of triggers. You only have to satisfy one. So the first one is if the client suffers a cognitive brain impairment, so they have a brain injury or they have dementia or they have Alzheimer's, any of those would be a trigger. The second one is if they lose two or more of their activities of daily living, things such as bathing, dressing, toileting, transferring from bed to chair, continence, eating, that would be a trigger. And then the last category is more of a physical. If they lose the use of an arm and a leg, or they physically lose an arm and a leg, or the ability to speak, or the ability to see out of both eyes or hear out of both ears, any of those would be a trigger. So that's what I mean about the fact that if something like that happens to you, you're probably going to need additional monthly benefits because you're probably going to have more medical bills. You might need to make modifications to your home. If you can't bathe, dress, or toilet by yourself, you're certainly going to have someone come into your home and help you with that. So that's the purpose of the catastrophic rider. So here's our first case study. We have a new professional. His name is Corey. He's age 28, and he's a first-year resident, and he is an anesthesiologist. The occupation class for an anesthesiologist is a 3M. So when we look at occupation classes, sometimes they can be as high as 6 or 5. 3 is right there in the middle. Anesthesiologists have a tendency to go out on drug abuse claims and or mental nervous claims. So that's why they don't get a very high occupation class. So he's an anesthesiologist. He's making about $66,000 a year as a resident. And this is the plan that we were able to put together for him. He qualifies based upon that dedicated benefit amount for anesthesiologists as a resident for $5,000 of benefit. We put all the special features on there, but we also included something extra, and that's the student loan rider. Obviously, if he's still going to school, there's going to be some student loans. So his advisor thought it would behoove him to make sure that we covered that. And this is the maximum amount that we could do is $2,500 a month, and it would be payable for 15 years. So I'm going to go into greater detail on how that works in just a minute. But here's the premium. It's about $25.54, and I put down here in the lower left what that rate is for a female, because right now I have an email in my email box about why the rate for me, being the husband, is so much lower than my wife. And it's because females pay about 70% more for disability coverage than males do between the ages of like 25 to like 45, late 40s, because it's the childbearing years, and pregnancy is a very common disability claim. So to accommodate for that, insurance companies charge females higher rates. In this case, it's about 70.5% higher. Okay. So what I want to go into now is that student loan. Obviously, this is at the top of everybody's minds right now because of the new student loan debt relief. So we were ahead of the game with trying to cover student loan. So insurance companies recognize that undergraduates and graduates are probably going to have some sort of student loan, particularly when we're talking about these professions, veterinarians, scientists, physicians. So we want to make sure that we were able to provide them with some sort of coverage in the event they become disabled. How is their student loan going to get paid for? So this is a program that is available for undergraduates and graduates. It can be a government or a bank-backed loan. It can't be like a personal loan. It will reimburse anywhere between $500 to $2,000 for an advanced degree, and then anything over like a bachelor's, and then anything under that would be $500 to $1,000 a month. Now, what this does is it takes into consideration that this is a separate monthly benefit. So when our resident was getting $5,000 a month, that's to pay his mortgage or his rent, his groceries, car, whatever he's got going on. He doesn't have to pull money out of that $5,000 to try and pay the student loan. This is completely independent. And he can choose the duration. I think we did 15 years on him. And the elimination period is going to be 90 or 180 days. So after him being disabled for 90 or 180 days, then the disability benefit to pay the student loan would kick in. It's a level premium. This is so inexpensive that they don't put it on a graded premium, and it's reimbursement. So what that means is if they have $1,000 a month student loan that they have to pay, they have to somehow come up with the first payment. make that payment, and then they show proof to the insurance company that they made the payment, and then the insurance company is going to reimburse them. And in theory, they take that $1,000 and they put it towards the next month's student loan debt. So that way, we've got a little pattern going of pay it and then reimburse, and then the reimbursement will go towards the next one. Okay. So our next specialty line is retirement. And we all know that you advisors probably are responsible for making sure that there's enough retirement funds there when your client chooses to retire. And I know for a fact that you rely on their income in order to put that money away. But what happens if they become disabled? That puts a whole big monkey wrench into your retirement plan for them. But that's okay because insurance companies have thought of that as well. So what the Retirement Protection Program does is it simply says that in the event that they become disabled, whatever they would have been doing, whether it be an IRA, a 401k, whatever they would have been doing with that money and putting it towards retirement, this is going to do a similar thing. And what I mean similar, obviously it cannot do a 401k or an IRA, but it can sort of emulate it. So money is put into a trust in your client's name, and it's when they become disabled, after 180 days, that money is going to be put into certain funds that you will help them choose. And at the end of every year, this is going to be paid taxes on any interest, income, capital gains. So in essence, it's something that could be gaining and growing, but taxes have to be paid on an annual basis for it, and they will be getting a 1099 for that. So in theory, that money will accumulate, and it'll be available to them to age 65, and it'll be almost tax-free, except for that last year that they might have to pay taxes on it. It is non-qualified money, so you cannot roll it over into an IRA or anything like that. Okay, so that's what the retirement protection is. And I wanted to show you a case study. This is Mark. He's a business owner. He's age 33, and he's a CPA. That's his practice. And so we already did his disability benefit, which was $33.45. He chose a 90-day elimination period. We put the usual, the FIO, the residual, the ONA-OC on there, the COLA, and the catastrophic rider with a monthly benefit of $32.80 on top of the $33.45 that he would be getting. And his annual premium is $1,060. But if we add that RPP on there, Retirement Protection Plan, this would be putting approximately $1,765 away every month while he's disabled towards, like I said, a retirement plan. And the price for this is $357. So it's really a small price to pay to make sure that you have the funds available to put towards his retirement, as opposed to trying to figure out how to plan for his retirement when there's no income coming in. All right, we're going to switch gears here, and we're going to talk about group insurance. And this is open enrollment season, so if you could kind of pay attention to this, this is something that I think you would find extremely helpful when you sit down with a client and you want to talk about disability insurance, and the client says, no, don't need to talk about it. I got it at work. I'm covered. And you say, I think it bears looking into a little deeper, because this is a situation where the client thought that he had everything covered, and then when the advisor looked at it a little closer, found out that you're getting 60% of your pay covered with your employer, and it's taxable. So it also has a cap. So it has a $5,000 cap. So regardless of what you're making, you're never going to get more than $5,000. And by the way, you have to pay taxes on that. So meaning he would collect $5,000 a month, but at the end of the year, he's going to get a 1099, and he's going to have to pay taxes on that $5,000 that he collected every month while he was disabled. In addition, he's in a sales position, so he gets a base and a bonus, or he gets a base and a commission. And the $5,000 is only on his base pay. So in order to illustrate this, we have this case study, who is John. He's an engineer. He's 47 years old. And if you took his $115,000 salary, you would see that that comes out to $95.83 a month. And if you multiply just his base salary by 60%, you're at 5750. So right away, he's over the max benefit, okay? But then if you take into consideration that he's got to pay taxes on it, so across the board, we just kind of say 25%. You take 25% of 5,000. Now he's left with really 3750 a month. Um, so this is where we have to, well, I try to help you as the advisor point out the deficiencies in some group cases. So in addition to the benefit not being enough, there's some other things that they need to know about group insurance, in that it does not have own occupation, like I talked about, where they could still collect it and be working. They don't choose the elimination period. Either the company does or the insurer picks that. It can be canceled. Either the insurance company can say, hey, we're not going to provide anymore, or your employer said, hey, pandemic, things are getting a little tough. I'm not going to offer disability insurance anymore. And then the rider options are pretty limited. Lastly, the portability and the convertibility, meaning if you leave the employer, do you have any disability that you can take with you, or can you convert it into any kind of individual plan from the group plan? Chances are the answers to that are pretty slim. So I just wanted to kind of compare. In a minute, you're going to see what we actually quoted, John, and how this 4480 came to be. But in addition to the $5,000 that he'd be getting from his group, we would be giving him 4480 a month individual. And after taxes, it would still be 4480 because he's paying the benefit amount of 4480, the premium, with after tax dollars when he's paying the premium to the carrier. So he wouldn't be taxed on that. We could give him the own definite or the ONOC definition, and we could also set the elimination period, whatever he wanted. This plan will take him wherever he wants to go across the country. He could change employers. It's portable, and he can choose the riders that he wants. So let's take a look at how this came out. So here he is, his monthly income with the bonus and with his base pay is $11,250 a month, okay? The take-home pay, again, we use 25%, is approximately $84.37. Like I said, he's got group disability. It's capped at $5,000, which is actually $37.50 when we took that 25%. We layered over $44.80 of an individual disability policy. So he would be getting the $44.80 plus the $37.50 gets him at $82.30. Now look at what his take-home pay was, $84.37. So we're getting him to $82.30. That's 97% of his gross of his monthly take-home pay. So that was something that we were trying to accomplish, and I think this would make him feel obviously a lot better about, in the event he becomes disabled, what he's going to have available to him. And I think it would make you feel better too, because obviously this does allocate some funds for retirement if necessary. So this is a handout. It is on our website under Advisor Tools. So if you want to download it so that you have it available when you're sitting with your clients and talking about, the group insurance that they have, this will help you talk through it with them. So the next thing I want to talk about is our, what I call our go-to place when I don't know what to do about a certain situation, whether it be a medical situation, whether it be a type of occupation, or an order of amount of income that someone's earning. And that's Lloyd's of London. Most individual disability plans have a cap of maybe 20 to 35,000 of monthly benefit, where Lloyd's doesn't. I have a client who has a disability policy for $150,000 a month if he were to become disabled. So what Lloyd's does is they determine if someone is an insurable risk, and we find an insurance company that is willing to take on that risk. So that's the purpose of the Lloyd's of London. And then also what they do is they make distinctions about the type of occupation. So lots of times we'll find someone that is totally uninsurable because they're kind of blazing a trail. And I have a case study on that with a a podcaster. So Lloyd's of London is something that we use in a standalone situation because the nature of what they do, they can't get coverage anywhere else. Or maybe they're maxed out on their individual disability and we're layering over another protection with Lloyd's of London in the event they become disabled. So um, the whole process of Lloyd's of London is a little different than your traditional disability. So lots of times we have to find out if they're insurable, and then they fill out an application. We send it to the Lloyd's of London, and then they'll say, okay, now that we have all this information, we're willing to take them on. And they literally have to pay a premium up front before they go through the underwriting process. So a little different, but I want to talk to you about the specifics, and that is that again, we can do atypical occupations, uh, professional athletes, my podcaster. I have a jazz musician who's a Grammy winner. Things that regular traditional individual disability underwriters would not want to cover. Age is not an issue. So with traditional disability, the age cutoff is usually about 64. With Lloyd's of London, we can go beyond that. The monthly benefits, like I said, can exceed traditional disability. The example I showed you was the $150,000 a month disability benefit. Um, for my doctors, my ophthalmologists, my orthopedic surgeons, we can get that specialty language in there. So if they can't perform surgery, the disability benefit is going to kick in, just like regular disability. It does have a limited benefit period, so you're not going to get to age 65 benefit period. We're only going to get like a 5-year benefit period, and then it renews. So that means every 3 to 5 years, we have to go through the underwriting process again and get them another policy. That's just the nature of the beast. Okay, so here's my podcaster. This is Sally. She's 40 years old, and she's a podcaster with another person, a partner, and they've been doing this for 6 years. And she's been making $250,000 as a podcaster. And Lloyd's of London said, you know what, her income has been pretty consistent, and we're willing to take this on. So her monthly benefit that we were able to secure for her was $13,500. And then her elimination period is 90 days. The benefit period is 5 years, just like I said. Most of the time, if you're 55 or under, you're going to be able to get a 5-year benefit period. Once you start getting into the mid 50s, they're going to limit that benefit period to 3 years. And also, you have to renew every 3 years as opposed to renewing every 5 years. And then we were able to put residual on there and COLA on there. So her premium was $36.93. So, here's a situation where I didn't think I'd be able to get her coverage at all. And she was pleased as punch to be able to get this policy, knowing that, if something should happen to her, she'd be able to collect $13,000 a month to help replace her lost income. Okay. And I also offered her the opportunity to look at critical illness, and we'll be talking about that a little later on in the presentation. So I want to talk about another example of Lloyd's of London, and this is Mickey. He's 50, and he's the CEO of his own market research firm, and he's making $1.4 million. And here again, traditional disability, it just would not be sufficient. So what we were able to do is get him a benefit amount of $65,000, elimination period of 90 days, a 5-year benefit period, and it's going to renew every 5 years. And you're going to look at this premium and you're going to go, whoa, why is that so expensive? So his annual premium is $26,000. But the reason it's so expensive is because Mickey was afraid, and so is his advisor, that because Mickey spends all the money that he earns, that there wouldn't be any money left over once he reached the 5 years. So at the end of the 5 years that he's disabled, he will get a lump sum of $3.4 million to live on, hopefully until he recovers or whatever the case may be. So that's why his premium's a little bit higher, because he's getting that lump sum at the end. Okay. So here's my professional athlete, and this one's kind of sad, but also it's kind of good because he did have the coverage. So he's a professional football player. He's been with me for like 2 or 3 years, and we take a policy up for him every July because he goes through the summer camp and decides if he's going to be playing, who he's going to be playing with. And so he took out a policy for $1.1 million. Now with athletes, it's a little different. It's a situation where we have them literally be disabled for a year, and then it just pays the lump sum all at once. It doesn't have an elimination period of 90 days or anything like that. So he's about to satisfy his 1 year elimination period because he did become disabled November of last year. So his annual premium was $10,000, and he'll be collecting. Um, right now, we're going, like I said, we've been going through the claim process, so he's just satisfying the elimination period. This is his diagnosis of why he can't play. Now, keep in mind when we're talking about this $1 million, this has got to be permanent. So he has to be deemed permanently disabled where he cannot play football again. Otherwise, if he plays football again, he's got to pay this $1 million back. Okay. So we started the claim, obviously, to get the elimination period started, got the medical records, and like I said, we're about a month away from him satisfying the elimination period. And finally, like I said, kind of a happy, kind of a sad. Sad that he is in the situation, but he was happy that he put this coverage in place because it's putting his mind at ease that he'll at least be getting this $1 million um, in a couple months. Okay, so my next specialty is business owners, and I'm not going to cover all these in great detail. I just wanted to kind of touch on business owners. So with business owners, we have some statistics here that 79%, there's a 79% chance that a 3 business owner, one of them will be out for at least 3 months or more. And what effect, obviously, would that have on the business? Um, 60%, which I was happy to see this, of business owners use a financial professional, but only 46% put some sort of protection in place. So here again, this is an opportunity for you to educate your business owners on the different protections that are available. The easiest way that I found for an advisor to kind of open the door to this topic is to just ask the question, if you were to go on vacation for 6 months, who and how would your business run while you're gone? Now, what do you think that business owner is going to tell you? Well, first of all, I would never go on vacation for 6 months. Well, yeah, we know that. But if you become disabled, essentially that's really what's happening. You're not able to work. You're not available to help with anything. So what's plan B? Who's going to step in and take care of things? How are the bills going to be paid? How are your employees still going to keep the business running? How are they going to get paid? So, ta-da! This is where business overhead protection, which is one of our most common business disability plans we use, particularly with you as advisors, your practice. What this does is it essentially says in the event that you become disabled, and hopefully you have your own personal disability plan that's going to pay your mortgage and your groceries and car and all that kind of stuff. But independent of that, you wouldn't have to pull money out of that to keep your business going. There would be a dedicated amount that you would have coming in to help keep the office going, providing there's someone in the office to keep it going. So obviously we would need to make sure that that's something that you've taken into consideration. And what that does is it just provides a monthly benefit, like I said, to pay expenses. Now, in addition to that, if you've taken out a loan, if your client has taken out a loan from a bank to maybe increase inventory, maybe bought a building, made some improvements within the practice, whatever the case may be, this has a rider that we can also make sure that independent of the business overhead, there's a separate rider that would take care of the business loan so that that doesn't get defaulted. In addition, we also have one called Key Person. And a key person, we're going to go into greater detail, is a benefit to the employer. It does not provide a benefit to who's ever designated as the key person. And then lastly, we have something called the disability buyout. And this is if you have obviously one or more owners of a business and all of them have to apply, but in the event one becomes disabled and is not going to be able to come back to work, this provides the money for the other owners to buy out the disabled owner's share of the business. And we'll talk about that in just a minute. So let's look at business overhead. Again, this is something that is on our website, and it's the business overhead expense worksheet. If you have someone who's interested in taking a look at this, this is the first thing that we'd have them do is let's figure out what the monthly expenses are. And the ones on this sheet are eligible expenses. In other words, they might have meals and entertainment expense, but you're not going to find that on here because it's not going to be reimbursable. So these are reimbursable expenses. And then independent of that, we would have them fill out a disability quote request on our website so that we could see, are they insurable, and then what's the amount that we need to insure them for the business overhead. Okay. So here's a case study to kind of help illustrate it. And I'm using a financial advisor because that's what all of you are. And here's Stephen. He's 31. He has an income of approximately $75,000. So he's able to get a monthly benefit of $10,000 to help pay for the bills, elimination period of 30 days. Notice that it's not 90, it's not 60, it's not 180. We want those bills paid right away. We don't want that sitting there. So that's why you have a small elimination period. And if they're not back after 1 year of being disabled, chances are they're not going to make it back. So that's why you have a smaller benefit period. And we put the residual and the FIO on there because we feel those are still two important riders in the event that they're able to work part-time. And then the annual premium for him was $1,300, and that's just not a lot of money. And it just gave him a lot of peace of mind knowing that he could keep his practice going in the event something happened to him. Okay. So the business loan, as I said, this just pays um, a monthly benefit, and it can be paid directly to the vendor or the bank or whoever's holding the loan. So it doesn't have to be a situation like with the student loan where it's reimbursable and you got to pay it and then you get reimbursed. They can pay it directly to whoever's holding the loan. So we have Craig here. He's 46 and he bought a practice. So he took out a loan for $650,000 and the monthly benefit was $65.80. He already started paying on this loan when we provided him this policy, so that's why the numbers are a little wonky. And here again, a 30-day elimination period, benefit period of 10 years. And if you were to pay this loan off early, we could just cancel the policy, so he doesn't have to keep it. And here again, it gives him peace of mind. He's got $3,089 to pay the pure premium on this in case something happens to him. That loan will still get paid, and he has a dental practice to go back to. Okay, so our next one is the key person. And as I mentioned before, the key person and disability buyout are two of the ones where there are some restrictions. So with the key person, it has to be someone who is of value to the company. They have to have been working there at least a year. Um, and essentially what happens is if the key person becomes disabled, the benefit is paid to the employer, and the employer can use it to either replace the key person or replace the lost revenue that the key person is not generating. So if it's like one of your salespersons or your technology person, it's just to help offset that. The disability buy sell is basically, like I said, to have some money available in the event that one of the buyers becomes disabled and we need to buy out his share of the business from his spouse or whoever has the shares of the business. Okay, so our next topic is group solutions. And group is really good in certain situations if, let's say, an employee has a medical condition and we can't get them individual coverage just because of the nature of it. When we have group coverage over 10 lives, it's guaranteed issues, so we don't have to answer any medical questions. So that's a resource that we can use. And then group is also good because it's less expensive than individual. So sometimes we'll do group and then we'll layer over individual for certain employees because they need that additional coverage simply because of their income. So let's talk about it in greater detail. So this past year, we had some good news that we could go down from 3 lives down to 2 lives. So that opened up a lot more opportunities to get disability insurance, to get life insurance. So these are some of the details if you're interested. For group life, it's a minimum of $10,000 of life insurance. We could go up to as much as 300,000. Life insurance can be one-time salary. We can build it any way you want it, but we have to do at least a minimum of 10,000. And the less underwriting just means that, like I said, if we get to 10 lives, there's guaranteed issue. If we get to, just 2 lives, there's going to be a lot more questions asked, obviously, because not a lot of premium coming in, and yet they have to be able to cover them. Okay, so group is based upon the number of bodies and the ages of the individuals. And with life insurance, we can actually expand upon that and do a voluntary where you can cover a spouse and you can cover children, and the employee would be paying that for their particular family members. On short-term disability, the benefit is paid weekly, so we could go up to 60%, up to $2,500 a week. If someone is getting paid a lot more money than that, traditionally within the office environment, if the salaries are much higher, we could raise that benefit beyond 2,500. And the benefit period is usually 13 to 26 weeks. Again, this is short-term disability, and you can choose an 8-day elimination period or more. So if you want to do 14 days or 13 days, you can do that. Long-term disability, that's a monthly benefit. So with group, we can do 60% to $6,000 a month. We can go higher. Again, if it's executives and they're making a lot more, we could jack that up to 9,000, 10,000, whatever a month. Benefit period, just like regular, goes to age 65. You can choose a 90-day or 180-day elimination period. Okay. We could also do an own OC if the nature of the group requires it. We could do an ONOC beyond the 2 years that's traditionally on group disability. So what I want to do here is just kind of give you some background. 2 to 4 lives. They do have to fill out questionnaire, the employees and the employer. 5 to 9 lives, the employer fills out a questionnaire asking if they know of anybody who's been out of work, anybody who's been diagnosed with any of these medical conditions. And then lastly, the 10 lives is a guaranteed issue. Okay, so these are some services that are available that are free, that get piggybacked on when you have a group that's choosing life insurance. So these are some nice perks that an employer can look good in the eyes of the employees, in addition to just providing the benefits. So here's some examples. This is a financial recovery firm. They have 12 employees. They did 500,000 of life, 200,000 for the executives, 100,000 for all others, and the annual premium was just under 5,000. We have short-term disability. They did 60% to 1,500 a week, 3 months benefit period, 8-day elimination period, 2587. Same firm. They did long-term disability, 60% to 9,000. Like I said, we jacked it up from the 6,000 to the 9. Age 65, own occupation. So they wanted own occupation all the way to age 65. And 90-day elimination period, premiums $4,700. So you can kind of see what this looks like. Here's a financial advisor firm with 3 employees. So this gives you an idea, a little bit smaller firm. We did 60% to 6,000, ONOC for 2 years, annual premium $2,437. So this is really inexpensive, and you look like a hero when you're providing this. We can also give dental, vision. I'm just going to kind of skip over this because I want to get into critical illness. So critical illness, I know I've just got a few minutes left, but I want to talk about critical illness because I know for a fact that everybody out there knows somebody who's been diagnosed or died, somehow has been touched by an illness such as a heart attack, stroke, certainly cancer. And critical illness might be new to all of you, but it's been around since the 80s. It was actually created by heart transplant brothers in South Africa who did a phenomenal job of saving their patients, but they were in such financial dire needs of replacing the lost income from recovering from their heart transplant that they really didn't thrive. And the 2 doctors kind of put their heads together and said, oh, okay, what can we do? Voila, critical illness was created. And since that time, it has been improved upon, modified. And so I want to share with you what exactly it does. It can be a standalone plan, or it could be layered over someone with life insurance, disability insurance, long-term care insurance. It runs the gamut. It could be used for people who are not eligible for disability insurance. So in order to understand it, it's important to know what happens with the payments. So someone can collect a benefit from critical illness regardless of any health insurance they have, Medicare, long-term care, disability. That's why I said you can layer over regardless of what you currently have. I wanted to point this out. I don't know how many of you are doing long-term care, but long-term care, obviously, you have to satisfy the 2 or more activities of daily living. This one also has a feature that if someone has lost 2 or more ADLs, it can pay a benefit. Okay, so if someone's waiting for their own long-term care benefit to be paid, they're in the elimination period, they could be collecting on this, and that could kind of help them through the elimination period on their traditional long-term care plan. You can use the money to do anything you want. You can go on vacation. You can put your kid through college. You can pay obviously your medical bills, your groceries, whatever you decide. There is no person dictating how this money has to be spent. It's really important because if you've got cancer and you need to obviously have special treatment, some health insurance companies won't pay for that. This frees up some money that you could use towards that. And then also, if you have to go out of state, out of city, whatever the case may be, it'll help pay for those costs as well. Okay. So what does it do? Again, I was trying to think from an advisor's standpoint, what would you appreciate about this plan? Well, it avoids obviously dipping into the retirement funds to pay bills. It helps replace lost income from a spouse that was working, but taking time off to take care of that spouse. So, it's hard when you're kind of torn between the two, but this kind of helps the situation. Maybe hire someone to, part-time to help take care of the loved one. And then this one again, it provides income while someone's maybe satisfying the elimination period on either on a disability or a long-term care plan. So this is just some background. The issue ages are 18 to 70. You can choose either years or a lifetime benefit. If the policy was issued between the ages of 18 and 67, the benefit is reduced by 50% at age 70, and they all do that. If the policy was issued between age 68 and 78, then the benefit is reduced by 50% on that third policy anniversary year. But either way, it's going to get reduced. And the premium does not drop. That's what everybody else asks. Does the premium go down? No, you still have to pay the same premium even though they've cut it in half. The benefit amounts can be anywhere from 5,000 to 500,000, and the policy is guaranteed renewable, meaning as long as you pay the premium, they can't cancel it, and the premiums don't fluctuate. So if you take out a plan and your premium is, $1,350 in 5 years, they can't raise the premium. It stays $1,350. It does have some return of premium options. They're not real popular because it's very expensive. You can also purchase some additional riders so that, if you feel like cancer runs in your family and you want to make sure that if you get 2 types of cancer in your lifetime, that you don't just have one benefit paid one time for that one cancer. You can actually get paid more than once for cancer. And this covers a lot of different medical conditions, which I'll show you in just a minute. So it just means that there has to be 6 months between those medical conditions. And you can also get it to cover your spouse and your children. I found that if you do, if they're close in age, it's more cost productive or more cost efficient to cover the spouse, being a wife, and then piggybacking the husband on versus the other way around. Okay, so benefit amount, like I said, 5,000 to 500,000. If the spouse is not working, so like if you are a high wage earner and the high wage earner is concerned about something happening to the wife who's the stay-at-home parent, who's going to take care of the kids if something happens to her, we could get her up to $250,000. Or if the spouse purchased critical illness, we could get up to 50% of whatever he purchased. So it really doesn't matter. The max is 500,000, so half of that is 250,000. So that's kind of how we got to that. The max would be 250 or whatever, 50% of what the spouse is making. And what they could do is they use the money to obviously hire someone to take care of the kids, a nanny, housekeeper, whatever the case may be. And then what's nice about it is if someone dies of one of the causes, the heart attack, stroke, cancer, renal failure, paralysis, coma, whatever, they get the premiums that they paid into the plan back minus any benefits that were paid. So if like with certain situations you only get 25% of the benefit, they would give the remaining premium back to the beneficiary. If one dies of a covered illness, if they die of a heart attack, they die of cancer, they die of stroke, if any benefits have been paid, they would pay them the remaining benefits that were not paid, and they would go to the beneficiary. So this is some when I talk about a portion of the benefits. So let's say a client had bypass surgery. They're not going to get, and they had $100,000. They're not going to get $100,000. They're only going to get a 25% benefit because they had angioplasty done, and that didn't warrant the full benefit. So they would, if they were to have a heart attack in the future, they would get the remaining $75,000 that they didn't get initially. Okay, so that's what it means. And if they were to die of a heart attack, it would go to the beneficiary that 75,000. Okay, so this just gives you an example of some of the things that are covered. And then people always ask me, well, how often are claims being paid? And this is just a sample of some of the types of claims that have been paid. And I thought it was interesting the professions and then also the age of because people might associate this with, okay, these are all the people that are getting paid because they're old and they've stroked out or they've had a heart attack. This clearly is not that. So like I said, all of us have probably touched someone that has had cancer, heart attack, stroke, something like that. Um, so this, I think, is a very impactful slide because critical illness pays more than once. So in theory, I just sort of laid this out for you. If we have someone who's 38 and they had a heart attack and they took out a $200,000 critical illness plan, they would get 100% of that benefit because they had a heart attack. So they would get their 200,000. And then let's say, God forbid, but at age 42 they had a stroke. Well, that's a completely different diagnosis. So they're going to get 200,000. And let's say bad luck followed them, 57, they are diagnosed with kidney failure. It's a different diagnosis, and obviously 6 months is separating these, so they're going to get another 200,000. Mind you, they're only paying the premium on one $200,000 policy, but yet they have paid out 3 times to a total of $600,000. Not to mention, everything gets paid back to a beneficiary if benefits weren't paid. Okay, so you might ask, well, Kath, how do you figure out how much critical illness someone needs? This is something that we kind of threw together. Obviously, you can use it or not, but you take someone's monthly mortgage and you multiply it times 2 years, and then you take into consideration, maybe maybe $10,000 of medical expenses that may not be covered by someone's health insurance. Obviously, that would be a lot more if they don't have any health insurance, which is kind of something that's going on now. And then any other essentials that you think they would need. Obviously, you would have to delve into their lifestyle a little bit more to know what those essentials would be. And then that would be what the amount needed is. And that would be a good starting point for the critical illness benefit. So here's some examples, and I did a variety of them just so you can kind of see where this would apply. So here's Kim. She's 45. She's an HR director, and she has lupus. So she's not eligible for disability because that's a autoimmune disorder that insurance companies are just not going to cover. So I obviously screened her with critical illness, and they didn't have a problem covering her. So she chose a $100,000 benefit. We put a critical illness and reoccurrence riders. So again, if she was to have, cancer more than once, this would pay the benefit 2 times. Her annual premium was $1,600. That's not a lot of money for the peace of mind that she's having that, God forbid, if something should happen to her. And she's working, she's able to put some money away, but this is just gives her a little bit of a safety net in case something should happen to her. And then here we have Eric. He's a dog trainer. He's not eligible for disability just because of his occupation. But he was making like $120,000, and he said, "What do you have available?" And so he chose a $200,000 benefit for critical illness, and he wanted the waiver of premium on there, so that way, if something should happen to him, he wouldn't have to pay the premium. And his annual premium was $34.85. here again, he's working, making $120,000 as a dog trainer, but this gives him a little extra protection in case something should happen to him. Here's another one, Brandy. She's 34, and she's a self-employed illustrator. Oh, hang on a minute. I'm so sorry about that. Technology here. And this isn't going into show mode. Okay, there we go. Okay, let me skip on through here. Okay, so this is Brandy, age 34. She's a self-employed
Kathy.
illustrator.
Kathy.
Yeah, it needs to go to the other side.
Yep. Swap
yeah,
it.
I'm doing it. Yep. And she has only been working for 6 months. So again, she didn't have enough where she was able to be eligible for disability insurance for critical illness. Again, it's not determined by her occupation. So they were able to provide her with a benefit that she thought was affordable, $75,000. And again, she chose to have those reoccurrence riders because of family history, plus she's 34, and her premium was only $642. So this is something that, again, it gives her an extra layer of protection until she's working longer, and then she would be able to apply for a traditional disability policy. And if she chooses to keep this, she can, or she can cancel it. And I've got one here, Annie. She's a physical therapist. She chose critical illness because during the pandemic, she had her hours cut because nobody was coming in for physical therapy. And so, in order to supplement her income, she was working for a coffee catering business 12 hours a week. Well, the traditional disability carrier didn't like the combination of what she was doing and wanted her to be working more as a physical therapy assistant before they would take her on as a disability client. So she said, "What can I do?" And I said, "Well, there's critical illness." So she chose a benefit of 75,000. Again, because she's young, she wanted those additional riders, and her annual premium was $807. So again, it just gave her an extra layer of protection until she was back to work full time, and we could apply for traditional disability for her. And this is my last one, Annie. She's my stay-at-home parent. This is a situation where the high wage earner was concerned that if something happened to her, he couldn't take time off of work to watch the kids and take them to school and do all that. So he wanted to have some money available to hire someone. So he took on a $200,000 plan for her, and this includes waiver of premiums, and the premium is $1,257. So this gave him some comfort knowing that, okay, in case something happened to Annie, he doesn't have to worry about her trying to do anything. He doesn't have to worry about him trying to do anything. He can hire some people in, hopefully, to help fill in the gap. And that's it. We covered a lot of ground. It's about 5 o'clock. Um, what makes LLIS different? Well, the fact that we have these free webinars. The next one will be coming up November 15th, Planning the Future with Long-Term Care. And then our final one, December 13th, Insurance Mistakes to Avoid in the Future. Okay, I'm going to take a look and see what the questions are. If there's something I can answer here real quick. Okay, is the lump sum payment under Lloyd's policies tax-free? Yes. The reason it's tax-free is because he's paying the premium with after-tax dollars. Some of these are really long. Let's see. For John, wouldn't his group disability not allow him to take the personal policy on top of his group policy? No, that's not true. When you take out an individual disability policy, you're asked, does someone have group insurance? And if they do, we factor it in, which is exactly what we did. If he goes out on claim, he could collect on both. John does not have an obligation to go into the HR department and go, hey, I purchased an individual disability policy, just want you to know. No, doesn't need to do that. He can collect both regardless. He can collect his social, if he applies for Social Security, which his group uh, um, insurer is going to ask him to do, he can still collect his entire individual disability benefit in addition to any Social Security benefits. So that's a misnomer. No, you can always collect on both as long as when you're purchasing the individual and you have group, you've let the individual carrier know. If female is medically infertile, could she be excluded from that 70% surcharge? Okay, I've had this question come up. If someone's had a complete hysterectomy, are the rates adjusted? Absolutely not. These are designed by actuaries, and they are not going to go back and individually look at someone's medical records and go, okay, we're going to reduce your rate. Um, is there an option to exclude childbirth from a disability policy for a woman? Okay, same question. No. Um, so some of these, what I will do is, Claudia, is there a way to know who sent these in so I could respond to them tomorrow?
Yes, we can send those
Okay,
out.
okay, because I know it's 5 o'clock.
It is.
So anybody who sent in a question, there's a ton of them here. I'll be more than happy to answer them tomorrow. And thank you again for joining us. And please join us next month for our next webinar on November 15th.